You take financial risks every single day, even when you think you're playing it safe. And the biggest risk you face isn't investing, it's misunderstanding how risk actually works. Most people think bigger risk equals bigger reward, but that's only true for gamblers. In the real world, the people who build wealth don't avoid risk, they control it. And the way they do it is completely different from what most people believe. Today we're going to break down the real truth about risk and reward, why most people get it backwards, how the wealthy think about it, and how you can use the same mindset to make smarter financial decisions for the rest of your life.
All right, let's dive right in. The first thing we need to get straight is this. When it comes to your money, you've been taught to fear the wrong things.
You know, your brain is hardwired for immediate threats. It sees the flashing red of a market dip or some scary headline on the news and it just screams, "Danger!" But here's the thing. The real threat isn't that loud, obvious storm. It's the silent stuff happening on the other side. It's inflation, kind of like termites, just quietly eating away at your savings year after year. It's the opportunity you lose by just staying on the sidelines. And that gap between what feels scary and what is actually destructive, that's where fortunes are lost. So this calls for a whole new definition of risk. Real financial risk isn't just about losing a bit of money on a stock. No, it's about not reaching the finish line. It's the risk of not being able to retire when you want to, not building the life you actually envision for yourself. The moment you start defining risk this way, everything changes. Every financial decision starts to look totally different. It's funny, isn't it? The path that looks the safest can be the most dangerous one of all. I mean, keeping all your money in a savings account feels so secure, right? But it's kind of like putting it on a slow conveyor belt that's heading straight for a cliff called lost purchasing power. You are guaranteed to lose to inflation over time. Fearing a downturn and not investing just means you miss out on decades of potential compound growth. So the key insight here is that playing it safe isn't passive, it's an active decision. And a lot of the time, it's the riskiest one you can possibly make.
But here's the thing. This whole misunderstanding, it's not entirely your fault. The problem is, your brain was built for survival, not for investing.
There's this incredible concept called loss aversion. Basically, what psychologists have found is that the pain of losing $100 feels about twice as strong as the joy of gaining $100. This is just hardwired into us. It's why a market dip feels like a genuine physical threat, and it pushes us to sell at the absolute worst possible moment. The emotional pain just completely overrides any logic we have.
And then you've got this other little glitch called recency bias. Our brain puts this huge magnifying glass on whatever just happened. So if the market drops for 3 days straight, our mind just projects that trend out into infinity, and it creates this overwhelming sense of panic. We forget to zoom out and look at the big picture, the decades-long journey of growth. We get trapped by the noise of the moment.
And of course, there's our deep, primal instinct to follow the herd. I mean, for thousands of years, sticking with the tribe meant survival. But today, it means buying into a bubble because of FOMO and then panic selling at the bottom of a crash because everyone else is. It just feels safer to be wrong with everybody else than to be right all by yourself, even when the crowd is running straight off a cliff.
So, when you put it all together, loss aversion, recency bias, herd behavior, these instincts were brilliant for keeping us alive in the wild. But in the world of modern finance, they're an absolute disaster. They consistently trick us into committing the cardinal sin of investing, buying high out of greed and selling low out of fear.
But here's the secret, the good news. You can fight these instincts with a better framework. And this brings us to how the wealthy approach risk. See, rich people don't avoid risk, they engineer it. Wealthy investors aren't making these huge, single bets. They're not trying to find that one magic stock that's going to make them rich overnight. No. Instead, they build a portfolio. They use something called asset allocation, which is really just a fancy way of saying they spread their money across different things that don't all move in the same direction, like stocks, bonds, and real estate. The goal isn't to get rid of risk completely, but to make sure that a fire in one room doesn't burn down the whole house.
And maybe their most powerful tool of all is time. While most of us are glued to the daily noise of the market, the wealthy are playing a totally different game. They're operating on a different clock. They think in decades. A long time horizon is the ultimate shock absorber. It turns all that short-term scary volatility into nothing more than tiny, irrelevant blips on a long journey of growth.
This all leads to a really game-changing idea, asymmetric bets. Sophisticated investors are always hunting for opportunities where the downside is small and you know exactly what it is, but the potential upside is just massive. Think of it like buying a $1 lottery ticket that actually has a realistic chance of paying out $1,000.
investing a little bit of time or money into learning a new skill, or starting a small side business. That's a perfect example. The most you can lose is small, but the potential gain could literally change your life. This isn't gambling. It's about intelligently stacking the odds in your favor.
And this brings us to a truly counterintuitive idea. To build real wealth, you can't just play defense all the time. Sometimes taking more risk is the safest financial move you can make.
So, that's the big question, right? When is it actually smart to lean into risk instead of running away from it? When does risk become your friend?
Well, the answer really lies in your situation. When you're young, time is your absolute superpower. You've got decades to recover from any downturns. When the market is filled with fear and everybody else is panicking, well, historically, that's been the moment of greatest opportunity. And anytime you invest in yourself, learning a new skill, starting that project, you're making one of those amazing asymmetric bets we just talked about. In these moments, taking a calculated risk isn't just an option, it's the engine of growth.
But of course, there's a dark side. Not all risk is created equal. And this, right here, this is where people destroy their wealth.
So where's the line? When does a smart, calculated risk suddenly morph into a reckless gamble that could just wipe you out? The warning signs are usually pretty clear. You're gambling when you invest in something you can't explain to a 10-year-old. You're gambling when your decisions are being fueled by FOMO or by fear. You are absolutely gambling when you bet money you cannot afford to lose. And you're playing with fire when you use debt or leverage, because that just magnifies everything. Your wins, but also your losses. Avoiding these traps is just as important as finding the right opportunities in the first place.
Okay, so I know this all might seem a little complicated, but it really doesn't have to be. You don't need to predict the market, you just need a process. So here it is, a simple 5-question framework you can use to guide you. Before any big decision, just ask yourself, 1. What's the absolute worst-case scenario here? And be brutally honest. 2. Can I financially and emotionally survive that worst case? If the answer is no, the decision's already made. You just walk away. 3. What's the realistic outcome? Not the lottery ticket fantasy, but the most probable result. 4. Is that probable reward actually worth the time, the stress, and the money? And finally, 5. Does this decision actually move me closer to my long-term goals, or is it just a distraction?
The reason this framework is so powerful is because it acts like a circuit breaker. It forces you to hit pause, taking that emotional, survival-driven brain of yours out of the driver's seat and replacing it with a simple, logical process. It's your best defense against making an impulsive decision you're going to regret later. So let's bring this all home. The biggest risk in life is doing nothing. It's staying exactly where you are and letting things like inflation and inaction decide your future for you. The goal isn't to run away from risk. The goal is to understand it, to respect it, and to choose your risks wisely. You don't build wealth by avoiding risk. You build wealth by understanding it. And once you learn how risk really works, you stop gambling and start building.